What if prices didn't rise? What if they started to fall instead? It may sound like a dream to get cheaper goods, but deflation, the opposite of inflation, could throw the economy into a dangerous spiral. Negative inflation can seem appealing at first, but it brings along a set of risks that could lead to widespread economic instability. Let's explore what happens when inflation turns negative and why it's not as good as it sounds. We're all familiar with inflation, the slow, steady rise in prices that affects everything from groceries to housing. It's a part of daily life, and while it can be frustrating, we've grown accustomed to it. Inflation is expected to be a natural part of any thriving economy. But what happens when this steady rise in prices stops? Or worse, what if prices begin to fall? This is the scenario known as deflation, and it's a phenomenon that could cause serious damage to the economy if it takes hold. When we talk about deflation, we're not simply talking about a temporary dip in prices. Deflation refers to a sustained decrease in the general price level of goods and services. While it might sound like a good thing at first, who wouldn't want lower prices? Deflation has far-reaching consequences that can lead to a long-term economic downturn. It's not just about cheaper products, it's about an economic environment that encourages people to spend less, businesses to cut back on production, and governments to struggle to get things back on track. So, how does deflation actually work? And why is it such a threat to economic stability? To answer these questions, we need to look at what causes deflation and its effects on both the economy and individuals. Inflation is often viewed as a sign of a healthy economy. It happens when demand for goods and services outpaces supply, and businesses raise prices to match the increased demand. In a growing economy, consumers are more likely to spend and businesses see increased profits, which in turn encourages them to invest and hire more workers. In this cycle, wages rise, and people feel more confident about spending. This upward movement of prices benefits debtors, as their debt effectively decreases in value over time. But when inflation slows down or reverses, it can lead to deflation. Deflation usually occurs in response to a combination of reduced demand, excessive supply, and shrinking money circulation. Essentially, deflation begins when consumers start spending less, businesses find themselves with excess inventory, and prices begin to fall as a result. The first sign of deflation often comes from a reduction in consumer spending. If consumers begin to expect that prices will continue to fall, they may put off making purchases. After all, why buy a new car today if you expect the price to be lower in 6 months? This reduction in demand forces businesses to lower prices to attract buyers. But when this process continues for an extended period, it leads to more drastic price drops and economic instability. At the same time, businesses facing a lack of demand may respond by cutting production costs, often through layoffs. If workers lose their jobs, they too stop spending, creating a vicious cycle that perpetuates deflation. As unemployment rises, fewer people can afford to buy goods and services, so prices continue to fall. This leads to more job losses, which further erodes demand, making it even harder for businesses to remain profitable. The economy as a whole shrinks during periods of deflation. Businesses that can't sell their products at a profit may be forced to close down. With more businesses failing, the economy's ability to generate wealth declines. A reduction in business investment adds to this problem. When companies expect prices to keep falling, they become less likely to invest in new projects, hire workers, or expand their operations. This lack of investment causes economic growth to stagnate. But deflation's most dangerous aspect is how it increases the burden of debt. In a deflationary environment, the value of money increases over time. While this may sound appealing for savers, it's devastating for anyone with debt. As the value of money rises, the real value of debts increases. If a person took out a loan to buy a home, for example, and then the economy goes into a deflationary spiral, the debt they owe becomes much harder to pay off. Wages are likely to stagnate or even decrease during deflation, making it even more difficult to meet obligations. Businesses that are heavily in debt face similar struggles. As the prices they can charge for their products fall, their ability to repay loans becomes even more challenging. The cycle of debt and falling prices worsens as defaults and bankruptcies mount. The result is an economy that becomes less dynamic and more prone to stagnation. The most notable example of deflation in recent history is the Great Depression of the 1930s. The stock market crash of 1929 sent the economy into a downward spiral, and the ensuing deflationary period saw prices fall sharply. By 1933, the United States had lost almost a third of its economic output, and unemployment had skyrocketed. During this time, wages were slashed, businesses failed, and the money supply contracted dramatically, which further fueled deflationary pressures. The economy didn't begin to recover until World War II, when government spending on military production sparked demand and helped pull the country out of the deflationary trap. In Japan, deflation became a persistent problem in the 1990s after the collapse of an asset bubble. Despite efforts by the Bank of Japan to stimulate the economy through low interest rates and massive injections of money into the economy, Japan entered what became known as the lost decade. Prices continued to fall, economic growth remained sluggish, and the country struggled to break free from deflation's grip. This period highlights how deflation can become entrenched and difficult to overcome, even with aggressive government and central bank intervention. So, how do governments and central banks try to prevent or reverse deflation? The main tools they use are monetary and fiscal policies. Central banks lower interest rates in an attempt to make borrowing cheaper, which encourages spending and investment. When interest rates are low, consumers are more likely to take out loans to buy homes or cars, and businesses are more likely to invest in new projects. If interest rates are already low, central banks may resort to other strategies like quantitative easing, which involves buying government bonds and other financial assets to increase the money supply and stimulate the economy. Governments can also use fiscal policy to fight deflation. This includes increasing government spending on infrastructure projects, providing direct financial aid to consumers, or cutting taxes to encourage people to spend more. The idea is to increase demand and boost the economy by injecting money into it. Despite these efforts, deflation can be extremely difficult to stop once it has taken hold. It's a dangerous economic cycle that's hard to reverse without significant intervention. Even when governments and central banks take action, the recovery process is often slow and painful. For example, after the Great Depression, it wasn't until World War II that the United States fully recovered, as government spending surged in preparation for the war effort. Similarly, Japan's prolonged battle with deflation has shown how difficult it can be to break free from a deflationary environment, even with years of policy efforts. In today's global economy, deflation remains a potential threat. Although inflation is the more common concern, deflationary pressures could emerge under the right circumstances. For example, rapid advancements in technology that lower the cost of production could lead to price reductions. Additionally, aging populations in many developed countries could lead to reduced consumer spending, putting downward pressure on prices. The ongoing impact of the COVID-19 pandemic on economies around the world has also led to new concerns about deflation, as many businesses have been forced to reduce prices in response to decreased demand. What does this mean for individuals? During deflation, people may initially enjoy lower prices, but the longer-term effects are far less positive. With wages stagnating or falling, job losses becoming more common, and debt growing harder to manage, deflation creates an environment of economic uncertainty. People find themselves spending less, and businesses find themselves struggling to stay afloat. If deflation becomes widespread, it can lead to a prolonged period of stagnation, with no clear end in sight. Understanding deflation and its consequences is key to preparing for the potential economic challenges ahead. It may not be the most immediate concern, but the risk of deflation remains a lurking threat in today's economy. If you found this video informative, don't forget to like, comment, and subscribe. Share your thoughts below. Do you think deflation could become a major problem in the future?